In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about Donald Trump's tariffs once again because they have recently gone live. We'll understand what it really means for all of us. And in the second story of the day, I'll talk about a very interesting new study that helps us see how stories can shape our economy. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 6th of March. Let's begin with the first story of the day. Look, a new trade war has sort of broken out under Donald Trump's presidential watch, and this time around, it is affecting some of America's biggest trading partners all at the same time. Now, for those of you who are entirely new to all of this, a tariff in very simple terms is like a tax on goods that are coming into a country. When these taxes go up, importers basically end up paying more money, and in turn, these costs usually show up in the prices that businesses and consumers face. Now, because the United States is the world's largest economy and they trade with many countries across the world, any big changes in US tariffs can create a domino effect of sorts around the globe. And to give you some quick context, the latest set of tariffs began in early February of this year. Donald Trump signed executive orders that immediately slapped China with a new 10% tariff on top of an already existing 10% tariff. And this means that goods from China will now face a total of 20% tariff whenever they enter the US. And at the same time, Donald Trump also said that Canada and Mexico would be hit with 25% tariffs on their exports to America, but he also gave them a 30-day grace period to fix what he called border security problems. Now, the thing is, that particular pause has just ended. So therefore, starting now, Canada and Mexico are seeing 25% tariffs on most of their goods. But this has just one exception, which is Canadian energy products like oil, which have a slightly lower tariff of about 10%. Now, these tariffs affect a huge amount of trade. America buys about $400 billion worth of goods from Mexico every single year and around $330 billion worth of goods from Canada. A very well-known economist called Joseph Politano pointed out how surprising it was that the US still put up a 10% tax on Canadian oil, since it would almost certainly push fuel prices higher for them. He felt as if it was almost like building a higher gas prices button and then actually pressing it in real life. Now, the situation is continuing to change, to be honest. Next week, which is on March 12th, there will be an additional 25% tariff on steel and aluminum, which affects imports from almost every country, including our country, India. And on top of that, Commerce Secretary Howard Lutnick recently hinted that President Trump might reach some kind of tariff agreement with Canada and Mexico, so there is a chance that these tariffs could be adjusted or even rolled back at the last minute. But by the time you actually hear this, events might have already shifted, but this is too big of a story to honestly ignore right now. Now, one reason it is so significant is the overall size of the trade that is at stake here. China, Mexico, and Canada alone account for about 1.3 trillion US dollars in annual goods which enter the US, which works out to around 43% of everything that America imports. What is also very striking here is that we are only 1 month and a half into Trump's second term as president, but still these new tariffs already match the total scale of the tariff hikes that he had introduced during his entire first term. Back then, for your context, between 2018 and 2019, new tariffs hit about $380 billion worth of goods. But now, in just a few announcements in 2025, they have equaled or even surpassed it in many cases. So the road ahead is definitely very rocky. President Trump has also mentioned that 25% tariffs on European Union might actually happen very soon, and he accused the EU of being formed to screw the United States. He also threatened in a recent address to Congress that starting April 2nd, the US would impose reciprocal tariffs on everybody. And by that, he basically means that if any other country taxes American goods, the US would end up responding with a very similar kind of tariff.
India charges us auto tariffs higher than 100%. This system is not fair to the United States and never was. And so on April 2nd, I wanted to make it April 1st. But I didn't want to be accused of April Fool's Day. That's not, just one day cost us a lot of money. But we're going to do it in April. I'm a very superstitious person. April 2nd, reciprocal tariffs kick in. And whatever they tariff us, other countries, we will tariff them. That's reciprocal, back and forth. Whatever they tax us, we will tax them. We will take in trillions and trillions of dollars and create jobs like we have never seen before.
Donald Trump also very specifically pointed to India here, and he claimed that we have taxes on cars that go higher than 100%. He said that these new policies could bring in trillions and trillions of dollars and could create a wave of jobs. Now, economists usually doubt that tariffs work this way, since they tend to raise costs and actually reduce trade, but that is how the president is framing his plan right now. Now, of course, the countries on the receiving end of these tariffs are not simply accepting them, to be honest. When the US raised tariffs on Chinese goods on the 4th of February, China answered immediately with higher taxes on American farm products like wheat, corn, cotton, and soya beans. Now, these tariffs are as high as 15% in some cases. China also suspended soybean purchases from 3 major US companies. And since many of Donald Trump's voters actually come from farming states, China's strategy here seems to be aiming at that particular region in order to put political pressure upon him. Now, Chinese officials say that they plan to fight America's trade war till the better end, as they quote it, which suggests that there is no quick resolution that is in sight right now. Canada has been even more aggressive in this reply, by the way. Prime Minister Justin Trudeau recently called Donald Trump's move a very dumb thing to do, as he quoted it, and he also announced a huge set of counter tariffs on US products.
But Donald, they point out that even though you're a very smart guy, this is a very dumb thing to do.
Right away, Canada put a 25% tariff on about 30 billion Canadian dollars, which is about 20.6 billion US dollars worth of American goods. And in 3 weeks, it will bring a second wave of 25% tariffs on another 125 billion Canadian dollars worth of imports, which cover big items like cars, trucks, steel, and aluminium. Various Canadian provincial leaders have threatened extreme measures as well. Ontario Premier Doug Ford has warned that he might cut off power to the US if Canada is annihilated by these tariffs.
If they want to try to annihilate Ontario, I will do everything, including cut off their energy, with a smile on my face.
Mexico has also promised a forceful response, but they have not yet given specific details about it. Their president, Claudia Sheinbaum, said that there is no motive or reason to justify these US taxes. So as more countries adapt a tit-for-tat approach, businesses and global markets are becoming a lot more nervous. America, Canada, and Mexico are very closely linked economically with supply chains that stretch across their borders. Many industries like auto manufacturing, etc., rely on parts moving back and forth multiple times before a final product is sold to customers. If each crossing gets taxed, costs will pile up very, very quickly. Some economists also fear that this could be the return of a darker period of international trade, one where each country raises barriers, growth slows down, and living costs go up. Now, several research organizations have tried to predict the impact of these measures, and the numbers look fairly grim, to be honest. The Brookings Institution believes that the new tariffs on Canada and Mexico alone would lower America's economic growth by about 0.25 or 0.3% if there is retaliation. And because the US economy is roughly $23.5 trillion in size, that impact could actually be a loss of 45 billion US dollars without any retaliation, or up to 75 billion US dollars if only Canada and Mexico fight back. For Canada and Mexico, though, which are much smaller economies and are deeply reliant on US trade, the hit to growth could be over 1% and also might jump to 3% once their own tariffs come into play. Job losses would likely follow this, obviously. Brookings estimates that America could lose 177,000 jobs from the 25% tariff on Canada and Mexico, and over 4 lakh if retaliation is factored into this. Canada, on the other hand, could lose more than 278,000 jobs, going up to 510,000 jobs with a counter-attack in place. And Mexico is even worse, where they stand to lose 1.5 million jobs, which also might rise to 2.2 million jobs if things escalate. Now, this is a massive blow to all these three economies. People sometimes point out that the US government might make extra money from tariffs, maybe around about $100 billion a year, but most economists think that the benefit is very overshadowed by the harm that is done to trade and to people every day. According to the Peterson Institute for International Economics, these tariffs will cost the average American household at least $1,200 every single year because they raise the prices of imported goods. The same group has also also found that increasing tariffs can actually increase a country's trade deficit rather than actually decreasing it, which eventually goes against one of the main reasons for presidents often saying that they impose tariffs. Goldman Sachs economists predict that even if things do not get worse, these tariff moves could reduce America's economic growth by a few tenths of a percent and push inflation up by about 0.4%. Now, companies are already nervous about this. Back during the 2018-2019 trade war between US and China, many businesses decided to hold off on new investments and hiring because they did not really know what might happen next. And that uncertainty now seems to be resurfacing. Executives at General Motors said that they will not spend heavily without any clearer rules in place. A poultry producer called Pilgrim's Pride said that there is still a lot of confusion about if, when, and where these tariffs will be applied. Zebra Technologies, which makes barcode scanners and printers, mentioned that their customers are now worrying about tariffs instead of actually expanding their own operations. Over here, it is also very important to recognize that these moves actually shake up the very foundation of international cooperation in the first place. For decades after the economic turmoil that partly led to the Second World War, the United States actually helped set up a rules-based international order in order to avoid the very kind of trade conflicts that we are seeing right now. But now, if America actually steps away from the rules that it once made itself, other countries actually might do the same. Questions, of course, because of that are piling up. Is it just the United States pursuing its own agenda, or the entire world trading system beginning to break apart? Will global supply chains that cross multiple borders be forced to change? Will central banks raise interest rates if prices keep going up, which could potentially harm growth even more? And finally, does this put a dent in force-shoring, which is the idea of moving factories and suppliers from China to ally countries such as Mexico or India? Now, some people actually worry that ironically, China actually might start benefiting if North American nations start fighting with each other. There are also signs that this trade war could expand even further. Jeff Gerish, who used to serve as a deputy US trade representative under Donald Trump, told Goldman Sachs that the president is likely to go bold and broad with tariffs in order to fix what he sees as unfair global trade practices. And Goldman's own team believes that what we've seen so far could be just a fraction of the tariffs that will eventually be imposed by this presidency. They say that once the US announces some tariffs, it might use them as leverage in negotiations, but after that, more taxes on imports could be put in place in order to protect domestic industries. And finally, broader tariffs might actually appear to address a wide range of trade balances. All of this uncertainty weighs on businesses, which often prefer stable conditions for planning and investing. Right now, though, the new 25% tariffs on Canada and Mexico, along with the already existing 10 plus 10% tariffs on China, are in effect. The steel and aluminium tariffs that are coming on March 12th may intensify things even more over here. Several other trading partners, including India, are bracing themselves for all of this. Even friendly nations to the United States could actually end up seeing higher tariffs on their goods. None of us, of course, know how this chapter of Donald Trump's second US presidential term will end. A deal might be reached tomorrow, or perhaps more tariffs will roll out in the weeks to come forward. Many companies are pausing their decisions, like I mentioned, until the situation becomes clearer, and that very freeze could itself slow down the economy. All that can be said with certainty right now is that the global trading system is under some serious strain. There are many moving pieces, and everyone is watching very closely to see if these tariff battles calm down or they end up escalating. With that, let's move on to the second story of the day and talk about a fascinating new study that helps us see how stories can shape our economy. Now, this study is based on the idea that our decisions are often influenced by the stories or the narratives that we believe in, rather than just by hard facts or numbers. So in order to understand how all of this exactly works, we will first need to understand an older idea from the economist John Maynard Keynes. See, almost 100 years ago, Keynes tried to explain why during the Great Depression, everything felt stuck in a negative spiral, even though there was not any clear logical reason for it. He said that people often act based on animal spirits, which means that they rely on their instincts and emotions when they make economic decisions. Sometimes people get overly hopeful, and sometimes they get overly fearful, and these collective feelings can actually lead to booms or even busts in some cases. Now, years later, Nobel laureate Robert Schiller added to Keynes' idea by talking about narrative economists. Now, Schiller said that a catchy story about the economy, if it is repeated often enough, can actually spread among people like a virus. Think of a phrase like, if you don't invest in AI now, you will miss out. If many people say it often and it also seems to sort of match with whatever's happening around them, it gets shared very, very widely. And eventually, it might create a wave of enthusiasm that pushes more and more people to actually invest in AI until the excitement peaks. But later, once the reality sets in or people get tired of the hype, the story might actually end up fading out, or it could even change into a new version of the same idea. See, until very recently, we did not really have great tools to study how these narratives spread or to even measure their impact. But a new research paper by Joel Flynn and Karthik Shastri uses natural language processing to track and analyze the words that businesses use in their official communications like earnings calls. They basically wanted to see how stories or narratives move between companies and how they affect decisions. One of the most important findings is that it's not just actual financial performance that makes firms invest or hire people. Instead, it's actually the optimism or pessimism that they feel about the future. When companies speak with confidence, saying things like demand is strong or there is a recovery on the way, they tend to hire more or invest more even if their balance sheet aren't really specifically strong in the first place. On the other hand, if they actually start saying words like uncertainty or headwinds, they usually become more cautious and they start cutting back on expenses and delaying new projects, even if their current sales or profits are absolutely fine. Now, all of this suggests that how people feel can really matter as much as any real economic statistic. The study also shows how these feelings or stories spread between businesses almost like a chain reaction of sorts. When a few major companies in an industry begin to sound optimistic or they start adopting a new technology, their competitors very quickly pick up on that very sentiment, even if their own situation has not really changed. Stories can then leap from one industry to another one. Over time, a single wave of optimism in one sector might actually spill over into unrelated sectors and lift them up as well. And the same applies to negativity, which can pull down a broader slice of this economy as it spreads apart. Interestingly, once a story or mood takes hold, it can stick around for a long time. This is sometimes called narrative hysteresis, which means that even if the original conditions that triggered the story have disappeared, the story can keep influencing decisions. Basically, a firm might have a bad sales quarter and latch onto a negative mood, then remain cautious for a long time, even if sales improve later. And that can keep the wider economy from actually bouncing back because everybody is still acting on yesterday's gloomy narrative. But on the flip side, overly optimistic stories can actually prolong booms beyond what real economic data would normally end up justifying. The paper by Flynn and Shastri estimates that these contagious narratives have played a big role in past economic downturns. For example, they suggest that during the slump after the dot-com burst, about a third of the drop in output was due to simply negative stories that were passed around in the public. In the global financial crisis of 2008, nearly a fifth of the downturn's impact may have come from fear-driven stories in the first place. And that means that while real problems certainly existed, a part of the downturn actually happened because people believed strongly that things were getting worse, and so they acted in ways that made things even worse. So all of this basically tells us that the stories we tell about the economy can become real in how they affect people's behavior. Businesses might listen to each other, believe that a slowdown or boom is underway, and make decisions that cause the slowdown or boom to materialize. So for anybody here who follows the markets or even reports on them, this particular story is a reminder that our words and narratives have consequences, and really so. They just don't explain the economy, they can also, in some small way, help shape it meaningfully. That brings us to the end of the two stories of the day. Let's now move on to the final section, which is the quick news headlines. First, Reliance Industries Limited has received a $2.81 billion demand notice from Ministry of Petroleum and Natural Gas regarding a long pending gas dispute linked to its KG D6 operations. The notice follows a February 14, 2025 Delhi High Court ruling that reversed a previous May 2023 decision which had dismissed the government's challenge to an arbitration award favoring RIL or Reliance Industries Limited. Second, State Bank of India has divested its entire 17.8% stake in Jio Payments Bank for 104.5 crore rupees, selling it to Jio Financial Services or JFS, which previously held 82.17% in the payments bank. Now, this deal values Jio Payments Bank at approximately 586 crore rupees. And following this acquisition, JFS will own 100% of Jio Payments Bank, making it a wholly owned subsidiary. Third, Coforge has signed a $1.56 billion US contract with US-based Sabre Corporation for a 13-year partnership that is aimed at enhancing Sabre's product roadmap and accelerating AI-driven solutions. Now, this agreement strengthens the long-standing relationship between these two companies, with Coforge CEO Sudhir Singh highlighting the deal's scale and complexity as a testament to their engineering excellence. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.